So tonight we continue our discussion on cost of capital. Cost of capital. Cost of capital is a very wide topic and is examination friendly. Yes, when I say examination friendly, it's very hard you sit for courses like financial management, SFM, without having a taste of what cost of capital is in the exams. We check the last diet, there is an element of cost of capital in that exams. So that is why I'm treating this topic first, so that nobody will have excuse that cost of capital is not clear to them. So as we solve, we still have enough time to go through it before the exams. So we've looked at various aspects of cost of capital. We said cost of capital is the return that the shareholders or providers of capital expect to get, but is the cost of borrowing to the organization. We look at cost of equity, we look at dividend valuation model, we look at CAPM on how we can compute cost of equity using dividend valuation model and CAPM. Under dividend valuation model, we look at using the historic approach to determine the growth rate and also the Gordon approach to determine growth rate under the dividend valuation model. We also look at the issue of preference shares. So we have two forms of preference shares: redeemable preference shares and irredeemable preference shares. And we also look at issues of debt, cost of debt. We said debt enjoying tax savings, and debt is a cheap source of finance. So the whole concept of cost of capital is, what is the sacrifice the organization will make in getting the loan, in using shareholders' funds? What is the sacrifice? And what will the shareholders, the providers of capital, get in return? So looking at these two sides of the coin is what cost of capital entails. Now, to an organization that have a collection of different forms of capital, such as debt, equity, preference shares, when you put all these together, the components of your capital make up your capital structure. That is, some organizations are solely financed by equity. It shows that they are not being financed by debt. They are ungeared. But organization which capital structure entails equity, debt, preference shares, it shows that they are geared because there is an element of borrowing in their source of finance. So debt is a cheap source of finance because it enjoys tax savings. There is tax shield on debt. So the more debt you have in your capital structure, the lower the cost of capital. The lower the cost of capital. So tonight, in looking at the average of these various sources of capital, will lead us to talk about what we call WACC, which is weighted average cost of capital. Weighted average cost of capital. When we talk about weight, over time, I've laid emphasis that weight is all about proportion, ratio, weight. Yes. So weighted average cost of capital is the average cost a company pays for all its sources of finance. And this is determined based on the weight of how much of each source is used. So if you have equity to be 100,000, you have debt to be 200,000, the total capital will be what? 300,000. So what is the weight of equity to the overall capital? It will be 100,000 divided by what? 300,000. What will be the weight of debt to the overall capital structure? It will be 200,000 divided by what? 300,000. That is the ratio, the relationship between the individual source of finance in relation to the overall capital of the organization. So when we talk about WACC, WACC is the minimum rate of return a company must earn on its investment to satisfy providers of capital. And these providers of capital entails debts, preference shares, and equity. Now, this weighted average cost of capital, somebody will ask, why are we computing it? Why are we computing WACC? WACC is used as a benchmark for an organization to accept a project when we begin to talk about project appraisal, investment appraisal. Any question?
No, sir. Sir, can you please take it to where you're talking about?
I don't have all
I mean
those
your
things in my
slides.
slides. I don't have them in my slide.
Okay, okay,
I
okay.
don't have.
Okay. All right.
So when we talk about WACC, which is the weighted average cost of capital, is a calculation of a firm's cost of capital in which each category of capital is proportionately weighted. So just as I've said that it is the average cost of the company's finance, such as equity, preference shares, debenture. It can also include other long-term debt instruments. So to calculate WACC, there are basically three methods to calculate WACC. We have the traditional method, and this traditional method is based on the market value. And when you're using market value, you must remember to adjust for ex-div and ex-interest, where the question is giving you your dividend income div, you know you must adjust to make your dividend what? Ex-interest. And when you are using book value, there is something you must note when you are using book value to calculate. I believe we all know what is book value. Book value is the historical value in your financial statement, your book of accounts. It's different from the current reality, from the market value. So the book value is historical. It might not reflect the true nature of the organization's capital as at today. So when you're using the book value and you're trying to compute for equity, note when you have reserve as part of your elements in the financial statement, you add your ordinary share capital and your reserves to make up the book value of equity for book value. When you're using book value approach, you're going to look at an example to illustrate that. And also, to calculate WACC, you can use the concept of Miller and Modigliani. Yes, the concept of Miller and Modigliani. Miller and Modigliani came up with some theories that at a point, tax is not relevant. Now, after some time, they debunk their argument that tax is not relevant to be tax is relevant in computation of WACC due to certain criticisms. So the concept of Miller and Modigliani approach to can be used to compute WACC, Based on what I have on the screen, I said the weighted average cost of capital, that is WACC, is the average cost of the different elements within the capital structure of the company, using the market value of the different elements as the basis of the are often easier to obtain. They have doubtful economic significance. That is, it is more meaningful to use market value. So to compute WACC, we can use table approach, and you can use this formula you are seeing on the screen. This formula you are seeing on the screen. Some students prefer using the table approach. You still get same results when you use this formula. And you must note something as you go through to study in different literatures. These figures, these alphabets can be represented in different ways. Based on what we have on the screen, we have KE, and the definition of KE is what? Cost of equity. Cost of what? Equity. We have VE, and the definition of VE is what? Market equity. If that is what they stand better, the major variables where they are appropriate. So VE is market value of equity, divide by market value of equity plus market value of debt. The definition of VE plus VD is the summation of the whole forms of what? Of capital. So the weight of market value all over the total capital you have in the organization. That is the expression of this. Take note, we said debt enjoys what? Tax savings. So for you to compute your debt, your cost of debt, you must recognize the issue of tax, where the question put forth tax rate. But where there is no tax rate, you ignore this and solve as appropriate. But where the question give you tax rate, you appropriate it into the formula and say 1 minus the tax rate given, multiply by what? The cost of debt. KD is the cost of debt, and VD is what? Market value of debt. Market value of debt. Divide by what? The overall capital of the organization, which is market value of equity plus market value of debt. So this is using the formula approach. You can also use the. So with this, I want to take a very simple example to introduce cost of capital, because some persons might see it based on experience, might think it's a complex thing, but I want to start with a very simple one so that you appreciate the concept better. Let's look at this example. We use the tabular approach to illustrate this, then we reciprocate using the formula to see if we arrive at same results. Example. Let's take down this example. Janet Worldwide. Madam Janet in this class. Janet Worldwide.
Yes, sir.
Okay, fine. I want to confirm if you're in this class. Has the following capital structure. Has the following capital structure. So let's say common share capital. Common share capital. We have it as 300,000. We have 7% preference shares. 7% preference share. Preference shares. We have it as what? As 100,000. We have long-term loan. Long-term loan. We have it as, let's say, 200,000. 200,000. The cost of equity. The cost of equity is 3%. Cost of equity is 3%. And let's say, and Janet Worldwide Janet Worldwide. Janet Worldwide pays 12%. Pays 12%. Pays 12% on bank loan. It pays 35%. 35% income tax. 35% income tax. Determine its weighted average cost of capital. Weighted average cost of capital. That is the looking at this question. What are we going to do? We are asked to determine the weighted average costs of capital. So please, you can screenshot the question in case you are not writing. In case you are writing, I would like you to take note of the question as I change this slide. So I'm going to use the tabular approach. Then we'll see how we use the formula approach likewise to solve that. Solution. For those of you that have that financial management material I put together, if you go to that question and answer kit, you see a question like this. They solve using the tabular approach. So you can also access that after the class. So using this tabular approach, I will say I have type of capital. Type of capital. I also have a feed for amounts. Also a feed for weighting. A feed for weighting. Also a feed for cost of capital. And a feed for what? For the WACC itself. So now, from the question, what are the types of capital? I need response. The type of capital, we don't know.
Share capital and preference share.
Another word for share capital is what?
Ordinary
share.
Ordinary share or equity. Now, what is the amount in the question?
300,000.
300,000. The other form of type of capital is what? Preference share. Preference shares. And the amount is what? 100,000. For debt, 200,000. So based on this, the total capital structure is what?
600,000.
600,000. Now, in terms of weighting, what is the weight of share capital to the overall capital, to the total capital? What is the weight? When we talk about weight, we're talking about the ratio. So what's fragment? Yeah, so 300 divided by 600,000 multiplied by what? 100.
50%.
So it means the weight of share capital to the overall capital is what? Is 50%. For preference share, it is what? 100,000 divided by 600,000 multiply by what? 100. We have a result of what?
16.67.
16.
Now, for debt, the result is what? 200,000 divided by what? 600,000 multiplied by what? 100. The result is what?
33.33.
Percent. When you add up everything, you should have what? 100%. You have 100%. Now, moving to this column, cost of capital. Cost of capital. Going to the question. For common share capital, the cost of common share capital is what? The cost of equity is what?
3%.
See it.
3%.
It's given free of charge. You don't need to sub for it. 3%. 3% is same as 0.03. Now, for preference share, the cost is what? For preference share.
12%. Okay.
For preference share.
7%.
Very good.
7%.
7%. See it here. 7% preference share. So that is the cost. 7% is same as what? 0.07. For debt, what is the cost of capital for the long-term loan? The cost is what?
12%.
5%.
Okay.
12%.
Okay, that's 5%.
12%.
See,
12%.
12%.
12%.
12% on bank loan.
12% bank loan is the debt. But take note, we have issue of tax, right? It pays 35% income tax, and this tax is associated with what? The debt. The debt. So what will now be the cost of debt? The cost of debt. The cost is 12%, right? Net of tax will be 1 minus what? 0.35. When you compute this, what will you have? What will you have? Multiply by 0.12.
0.078. 7.8%.
0.078. So these are the costs of what? Capital for each of the capital elements. So what will now be the WACC for share capital? It will be 50% multiplied by 0.03. For share capital, we're going to have what? 0.5 multiplied by 0.03. We're going to have what? 15.
15%.
1.5.
0.015. 0.015.
1.5. 1.5.
It's 1.5. I'm also punching my calculator. 0.03 multiplied by 50%. 50% is what? 0.5. Confirm that. For preference share, it will be what? 0.07 multiplied by what? 16.67%. Zero 0.166 plus 0.07. We have it as what?
0.1
or 0.17.
Okay. 0.17.
1.1.
Okay, 1.2 approximately.
1.1. 1.2, right?
Yes, sir.
1.2 approximately. Then for this, the result will be what?
2.6 approximately.
2.6 approximately. So overall, when you add everything, what will be your WACC?
5.1.
0.3%. 5.3.
5.3.
Ah, my. Okay.
5.3%. Who is not clear? Madam Victoria, can see your hand up.
Yes, sir. I wanted to ask how you got the cost of capital for preference share of 0.07.
See it here, 7% of preference shares.
Okay, thank you.
Hello, sir.
I can hear you, sir.
1.5%. 1.5%. How do you get all that amount? Because I'm pressing my calculator, I don't get that amount.
This 1.5.
1.5, 1.2%.
For the first one, on your calculator, 0.5 multiplied by 0.03 multiplied by 100. What will that give you? Have you punched your calculator?
Yes, that one gave me 1.5.
You
The
do
second
same for others.
Okay. All right.
0.1667 multiplied by 0.07. Depends. You might not follow that pattern. You can just do it in percentage. One will be in figure, one will be in percentage. You get that result. Let me see. 16.67 multiplied by 0.07. Yes, when you do it that way, you get 16.67 multiplied by 0.07, you get 1.12 approximately. Hope you are there, ma.
Sir.
You've not gotten it?
Yes.
Under your calculator, type 16.67 multiplied by what? 0.07. What will you have, please? What do you have? I don't know if you've gotten it. Just punch your calculator, you get it, ma. So,
Yes, sir. Continue, sir.
but have you gotten it?
No.
Press this thing on your calculator. Hope the calculator is very fine.
Yes, so
So
I
press
got
it.
the first one right now.
So see this figure, 16.67 multiplied by 0.07. There should be no break in transmission.
Yes.
If not, if I'm just going like that, you just be looking at what we are doing.
Okay. 16.67 multiplied by 4.07. That one gave me 1.1669.
So approximately, is it?
Okay, I will not multiply it with 100 again, Abi.
No, no need to multiply it with 100. It's already 1.2, 1.16.
I got it right now. Thank you, sir.
So using the formula, can you write this formula down in your book? Let's use this approach. Let's see. Let's see what this will give. So, I believe we have it in our book now. I'm supposed to add 1 here. That is cost of preference share. Okay, this one said it's supposed to be like 3. Let me add plus get value of preference shares. Since I have 3 forms of capital, if you have 2, you solve in that approach. Value of preference shares. And this value of preference shares plus value of preference shares. So we're going to apply this formula now to solve for WACC. Now with this formula, your cost of equity is what?
0.5.
Your cost of equity
1.15.
KE is what? Cost of equity from the question.
0.15.
No, see, it's cost of equity.
3%. 0.3.
Question now. Forget what you've done before. Fine. Forget what you've done before. We are using the formula now to put the variable 0.03. Your market value of equity is what?
300,000.
Fine, 300,000. We're trying to substitute 300,000. Now, when you add everything, the denominator, when you sum up everything, that is this 3, the result is what?
600,000.
600,000. That is what we're trying to do. So your cost of debt is what? On the question. You said 12%, right?
Yes.
But there is tax elements. The formula is already giving you that is 0.12. The tax rate is what? 1 minus 0.35. So your market value of debt is what?
200,000.
Are you sure?
200,000.
200,000. See, 200,000. 200,000. Overall,
600.
Good.
600,000. The cost of preference share is what?
7%.
7%. So we have it as what? 0.07. The market value of preference share is what?
100.
Overall here,
600.
600,000. So when you use your calculator, at this point, you must be very careful on how you press your calculator. If not, you can be here for 1 hour and be imagining what kind of thing is this? Who sent me? You understand? So you do it one after the other. You compute everything in brackets, multiply by this, you write your answer. You treat this one, So let's do it together. Let's see. So for the first part, 300 divided by 600 will give you what?
50%.
Multiply by
0.5.
0.03. You have what?
0.15. 1.5%.
That is same as 0.015, right? So for this other part now, 1 minus 0.35 will give you what?
6.5.
0.65. Multiply by 0.12. Where is this calculator?
0.078.
Very good. 0.078. Put that on one side, write it one place. When you divide 200 by 600, what will you get?
0.333.
Multiply by 0.078. You now have what?
0.026.
That is that for that. Plus, coming to reference share, 100 divided by 600,000. You have what?
15.15.
Multiply by 0.07.
0.011.
When you add everything, your result will be what?
Zero point zero five two 0.053.
Approximately, right?
Yes, sir.
So when you get it in percentage, the result will be what?
5.23.
5.3%. So compare with this. Are we on the same page?
Yes, sir.
So you can see. So whichever approach that is appropriate for you, adopt. Adopt. Whichever one you think is much more better for you, you work with that one. The essence is for you to solve it right and pass. The examiner will work whichever approach that you've put forth. Now, the question is this. This whole computation, 5.3, what is the meaning of 5.3? I was looking at the past question, the last night. I was seeing a question on the need for a particular variable, maybe internal rate of return or what. So the examiner was trying to ask, beyond your ability to compute, what is the essence of WACC? Why are we computing WACC? You must know. And I want you to know. So based on your own understanding, why do you think all this drama is important? Though I've mentioned some at the beginning or at the introductory part, but I still want to hear from you. Why do you think WACC is important?
I think the company, it is important because companies use it as a benchmark to appraise their investment.
Very good. That was one of the points I raised while I was introducing the concept of WACC. Yes. So WACC is one of the most So WACC is one of the most important figures in assessing a company's financial health. And it is used both for internal purpose, when you're looking at capital budgeting, and for external purpose, likewise, when you're trying to value companies' investments in the market, you use WACC as a benchmark. And one more thing about WACC is that it gives companies an insight into the cost of their financing, because it can be used as a hurdle rate for investment decision, and it acts as a measure to minimize risk. Now, by the time you want to venture into a business and you compute, and your return on investment will be less than 5.3%, the decision is to reject that investment. But once your return will be higher than 5.3 or equal to 5.3, fine, you can accept that investment. You can decide to venture into that investment. So these are some of the importance of WACC, of computing WACC. We are not just computing for computation's sake, but for organization to make decisions with it, and that is why it is being computed. You might ask that, is it important? How many organizations are using it? One thing I've discovered is that most organizations in the developed countries are using all these variables, yes, to come up with decisions. Yes, they are using it to come up with decisions that has to do with their daily activities. It's just that in our own country, we are not that industrialized, and most organizations sometimes don't use some of these variables. So it is being used by most organizations. So we'll look at another example. Maybe you'll be able to help me solve that. I don't know. But let me see if I have anyone here. I have, but let me see. Okay, I think this one is good. This one is a good one too, that we can look at. This is a good one. The question reads us that the account of Raji PLC reveal the following capital structure. We have 1 naira ordinary shares of what? 2 million. Reserves, 3 million. 10% debentures, 1 million. Overall is what? Is 6 million. Market value of the above are as follows. Ordinary share, we have 3 naira 75 kobo ex-div. Ex-div, it means it's excluding dividend. Dividend have been paid. Debenture stock, 80 naira. The cost of equity is estimated to what? To be 20%. The cost of debt is what? 7.5% after what? Tax. What is the interpretation of this after tax? So that when we start solving, we'll not have issues. What is interpretation of after tax?
Interest have been deducted.
You have already paid the tax.
Fine. That 1 minus t have been solved. So it's just for you to pick 7.5. So that when we start using the formula, you're not saying, but we didn't use 1 minus t. The statement has cleared it up. After tax. After tax. So this value is after tax. Those ones we used to say 1 minus t is before tax. Before tax. So once it is after tax, you ignore 1 minus t. So the question is, what is the WACC using book values and market values? I made mention of something about book value the other time. Who can recall? I said something about book value. When you're using book value.
The historical cost.
Yes. Historical cost, then When you see reserve, what will you do with it?
You add it up to the you add it up to the
To your
You
ordinary
had
share.
share.
You add it to the ordinary share to form, it will form part of your equity, part of your total equity. So the question I want us to solve, what is the WACC using book values and what market values? What is the WACC using book values and market values? So let's see how we solve this.
You are still writing.
Oh, sorry. It's good you write too. You know, when you write and you see your own writing, you'll be happy. And the understanding will come. But when you are waiting for my slide every time, it might not be good. So it's good you write. And once you are looking for one figure, you know where to get it because it's your writing. And Victoria, your camera is on. Are we through with the writing?
Yes, sir.
Yes, sir.
That's fine. Solution. Solution. Using book value. Using book value. Let's write small story now. So when calculating WACC, using book value, the nominal value of ordinary share, nominal value of ordinary share and reserve should be added together. Should be added together. But let me ask, I know somebody is having it in mind. Why are we adding reserve to ordinary share? Those of you doing financial reporting, why are we adding reserve to ordinary share based on book value?
Because it forms part of the net asset of the company.
Okay. So this reserve, it belongs to who? Yes, I like that your response, man. It belongs to who? Reserves. Who are the real owner of the business?
Ordinary shareholders.
Ordinary shareholders. So reserves belong to ordinary shareholders, and it represents shareholders' funds, just like share capital. So that is why when trying to determine the value of equity based on book value, we add the ordinary share capital plus reserve. Also in form of, the reserve can also be in form of retained earnings. Yes. So that is the basis. So because those reserves are profit retained in the business, so they belong to ordinary shareholders, and they have no fixed return. So that is why it is being added when you are solving based on book value. Based on book value. So that we'll not just write without understanding. Now, based on what we've put down, the value of ordinary share capital in the question is what? Ordinary share
2
capital.
million naira. 2 million naira.
2 million naira. The value of reserve is what?
3 million.
3 million. So the total equity will now be what?
5 million.
5 million.
Total equity 5 million. Now, based on this, our overall capital in the question is what? The total capital in the question is what?
6 million.
6
1
million.
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 So the total capital, when you add everything, will give you what?
6 million.
6 million. So what is the weight of equity on the overall capital? What is the weight of equity on the overall capital?
83%. 3%.
Weight of equity on the overall capital. We have it as what? 5
Multiplied
million.
by 6 million. Multiplied by 100.
So we have it
83.3.
83.33%. The weight of the debenture of debt is what? Debenture. Because in the
16
question,
points.
value of debenture is 1 million. So you now have it as what? 6 million. Multiply by what? 100.
100.
So we have it as what?
16.67%.
16.67%. 16.67%.
16.6.
So now, what will now be the WACC? What will be the WACC? The WACC based on the book value will be what? Based on book value. The cost of equity is what? The cost of equity.
20%.
The cost of equity. See, the cost of equity is estimated to be what?
20%.
20%.
20%. So 20% multiplied by what? The weight.
8.33.
Yes, this. Instead of bringing the formula, we just put 20% here and do it's the same thing as we already solved this already. So it's just to multiply 20% by what? By 0.8333. So we get for that. That is for equity.
7.16.
For debt, it will be what? 0. Let me be consistent. For debt, the cost of debt is what? Based on the question. The cost of debt is what?
7.5.
7.5.
7.5.
7.5% multiplied by what? 0.1667. When you solve, what will be your result? When you solve, the result will be what?
Zero point 175.
Okay,
That is 17.5%.
approximately. WACC will be 18% approximately. This is based on book value. This is based on book value. Now, when you want to solve using the market value, what will happen? Any question based on this before we move to the market value? Any question?
Good, sir.
For now, when you go back and solve it again, maybe question will come. Using market value. Using market value. When using market value to calculate WACC, as deep share price, or X interest price is used to multiply. It's used to multiply with what? With the nominal share. With the nominal share or nominal value of debt. Or nominal value of debt. Go back to the question. We want to use market value now. We want to use market value. Let me ask. We have 1 naira ordinary shares. Everything amounts to what? 2 million naira. I want to ask a question. How many ordinary shares do we have?
It's 2 million.
2 million.
Okay, we have 2 million ordinary shares.
Yes.
Yes, sir.
Isn't it? So why is it 2 million?
Yes, sir.
1 times 2 million. 1
1
divided by
naira
One
times
time.
2 million.
Yes, 1 multiplied by 2 million
That's
is
2
2
million.
million. Yes, that is why. So it means if you want to get the market value of 2 million shares, what will you do? You want to get the market value of 2 million shares.
Multiply
2
by
million multiplied by 3.75.
Yes,
Multiply by the 4.
yes, see it here. Ordinary shares, the current market value is this 3 points.
75.
This is for 1. For 2 million shares, 3 naira 75 kobo multiplied by 2 million ordinary shares will give you the
7.5.
overall. Yes, that is the overall market value. For debt, when talking about market value, I said reserve is not part of it. For debt,
Yes.
what would be the market value of debt? Market
80
values
naira.
of the above are as follows: ordinary share, debenture. So this is the value of the debenture.
80 naira.
18
Is
naira.
it
80
Is it-
over 100 multiplied by 1 million.
okay? Is it 80 naira now? 80 naira. So 80 divided by 100, right?
Yes.
Why are we dividing 80 by 100?
Because
The
it is
nominal price.
part of 100 naira.
So debt, the nominal value of debt, of one debt is what? 100. Is 100. Is 100. Debt from our previous class, debt is valued at what? 100. So for you to know, for these debentures now, for this debenture, if you are asked, how many debenture value will you get? I want to know the person's mic that is causing echo. So how many loan notes will you have in 1 million? How many loan notes will you have in 1 million?
10,000.
10,000.
10,000.
Okay. So 10,000 multiplied by 80.
800,000.
Yes, I'm just trying. Let me show it. I'm just trying to show us different approach. Somebody will say, why is it that we are saying the nominal value of debt is 100? Now, if the nominal value of debt is 100 and you have 1 million, how many loan notes, how many debts do you have in 1 million? You can say 1 million divided by what? 100. You have how many debts? 10,000. So 10,000 multiplied by 80 will give you the value of what? The 10,000 debt. In another way around, you can say this 80 divided by 100 is still the same thing. 80 divided by 100 multiplied by what? By 1 million. You get same results. Same results. Same results. So the nominal value of debt is 100. So now, let's show it. Let's show it. So we have market value of equity. What is the question? Is it question?
Yes, sir. I wanted to ask this nominal value that you for the bench for the debt that you said is 100. Is it constant? Is it always 100?
Constant, just like ordinary share, which is 1. It's constant.
Okay,
Just like
sir.
equity is 1. Anything below 1 is at discount. Anything above 1 is at what? Premium. So for debt, it is 1, except otherwise stated in the question. Except otherwise what stated in the question.
Okay, sir.
So market value of equity, we have it as what? 3.75 multiplied by what? 2 million shares. 2 million shares. 2 million shares. When you multiply that, the value will be what? The value will be what? 7,500,000. That's the market value. Market value of the venture. Market value of the venture. This will be what? Let's show the workings here. We have 80 divided by 100. This will give you what? 0.8. Take notes. So 0.8 multiplied by what? 1 million naira. And this will give us what? 800,000. In another way, let's show this. This 1 million. 1 million divided by what? 100. 1 million divided by 100. Multiply by what? 80. We still give you that same result.
800,000.
We still give you 800,000. I'm just showing it in different ways so that when you are reading, you begin to ask yourself too much questions. 800,000. So the total market value of equity will be what? I say total market. The total market value of the whole capital will be what?
8,300,000.
Equity plus debt. And we have it as what? 8,300,000. 8,300,000. The next thing is for us to determine our WACC. Our WACC. To determine the WACC, let's go and pick this. Determine our WACC. Let's see. We use this formula here. We use this formula here. So when you apply this formula, your cost of equity in the question is what? Cost of equity?
20%.
20%. So your KE is what? Is 20%. Into the bracket of what? So KE is 20%. Your market value of equity is what?
7.5
7.5%.
over
7
8,300,000.
8,300,000. Your cost of debt will be what?
Cost of debt still remain 10%.
7.5.
7.5.
7.5. They remove tax on our behalf.
Yes.
So we don't have any issue with this. So cost of debt is 7.5%. %. Then the market value of debt is what?
800
800,000
divided by 8.3.
divided by 8.3. So when you solve this, what will be your results? Your WACC will be what? WACC will be equal to what?
%.
18.79%.
So approximately
19%.
19%.
10%. This is the WACC when you solve using the market value. So the question is, why is the market value higher than the book value? Any response to that? A very simple thing. Yes? Why is the market value likely to be higher than the book value? It's a very simple response you just need to give.
Do we say growth level?
It's because of the market price of the equity, the value of the market price of the equity.
Okay, it's based on past
This
condition.
was not added.
The book value is based on what? Past condition. So it ignores the business risk, it ignores inflation, it ignores market interest rates, and so on and so forth. So that is why the book value will not reflect the current situation. So that is why you always experience a difference between the book value and the market value. Any question about this?
Sir, please come again. No.
About what, man?
About why the market price is higher than the book value.
Okay, I said the market value is higher than the book value because the book value is based on past price, is based on historical price, does not reflect the true situation of things as of now. So you know the book value, they are only recorded at the issue price, not at the market price. So, and one thing with the book value, You cannot go to your book of accounts and begin to adjust for inflation, business risk, market interest rates. So the market value reflects all these changes, and that is why the market value will be much more higher than the book value.
Dr. Tope, can we add that time difference of money too? Is it possible?
Very well. Very well, ma'am. And that is where the issue of interest and inflation set in.
Sir,
Yes, ma'am.
if the first method, like cost of capital, work, amounts, and the other one, so that maybe you should cross-check whether we get the same answer.
But I didn't get your question, ma'am.
My what?
Your question, ma'am.
My question. You know that when we are solving the first one for us, we are using type of capital, amount, weight, cost of capital, work.
Yes, ma'am.
I want you to use that method.
You're going to do that as an assignment, ma'am.
Yes, sir.
Do you get, ma'am?
Yes, sir.
Yes.
You do that as an assignment. It's when you do it, you know it better. So I want to see it, Madam Yunus. I will follow you up. Do it as an assignment.
All right, sir.
Yes, Madam Victoria.
Yes, sir. I didn't get 19%. Can I get the value of the cost of equity and the cost of debt? I don't know what they got to get 19%.
Punch your calculator, ma. 7.5 divided by 8.3 multiplied by 20%. You should have approximately 18.07%.
So the 7.5 multiplied by what, sir?
No, do 800,000 divided by 8.3.
Okay. I'm getting 0.096.
No.
Yes, he got it for the debt side.
Debt. 0.096. So if I should multiply it with 7.5%.
Okay. So 800 divided by what? 8,300,000 multiplied by 0.075 multiplied by 100. I'm getting 0.0.72. 0.7.
Okay, sorry, I got it. I thought the whole work is 19% for the two, for the computation of two, for the two.
So this is what you should have, man.
Yes, it's correct. So I was thinking you have added the equity plus debt together to make it 19. I don't know, it's only equity you added. I got it, sir.
All right.
Thank you, sir.
Now you know, sir. You're gonna solve that one. Is a very simple thing now. Just plug in the variable sharp and give me the answer.
Which assignment, sir?
It's assignment, but it shouldn't take long.
Okay.
That is a very important thing about cost of specific cost of capital. There are some organizations that might want to diversify from what they are doing currently into another industry, into another particular business. So the process of diversification might alter their business risk, might alter their normal way of operation. So in trying to diversify, there is a need for them to get a model, a business model in the industry in which they want to diversify into, to study the business risk associated in that industry they want to diversify into. Because every industry has its own business risk. So as you are planning to diversify, definitely there will be an expected change in your financial or your capital structure. So when business and financial risks of a company are expected to change, when a business is trying to diversify into another industry, the organization or the company will need to appraise the new investment or the new sector with an appropriate cost of capital. So when you are trying to appraise that, you have to look at what we call business risk. And when we talk about business risk, what is business risk? Business risk is a risk that is associated with the industry in which a company operates. Financial risk is a risk associated with what? With debt financing. Because the more debt you have, the more financial risks you are experiencing in the business. And the more debt you bring into the business, the more the equity holders, the shareholders will demand for higher return because you are exposing them to risk. So when a business is solely dependent on equity, being run by equity, the level of financial risk is zero. But as debt is being introduced, the business experiences what? Financial risk. So if company A is trying to diversify into mining industry from agriculture, they are trying to diversify into mining industry, there will be need for them to get a proxy company. What is this proxy company? A company that have been operating in the mining sector, in order for them to identify the business risks in which these companies face. So proxy company is a company that has similar business risks with the main company. So it is assumed that the business risks within the equity betas of these comparable companies is similar to the business risks. In the last class, I asked what is beta. So beta, when we're talking about CAPM, that beta is a measure of risk. Beta is a measure of risk. So we have various forms of beta. We have asset beta. We have what? Equity beta. Yes, we have asset beta, we have equity beta, we have debt beta.
Hello, sir.
As
Hello, sir. Hello.
I can hear you.
I got the same answer with you.
So good. So it's good now. It's good to solve it yourself. At least you'll be very much happy now.
Yes, sir.
Very good.
Thank you, sir.
So asset beta is used to measure the risk associated with the industry in which a company operates. That is asset beta. Asset beta. So when we talk about equity beta is measuring what? Equity beta is a measure of what? Business and financial risk. And this equity beta is usually greater than the asset beta because it's a combination of what? Business and financial risk. But asset beta only measure what? Only measure the business risk. And take note, there are two forms of risk. We have systematic risk and unsystematic risk. So what is systematic risk? Sometimes we get confused with these terms. Systematic risk. What is systematic risk? Yes, can I get it?
Systematic risk are risks associated with the business.
Okay.
Yeah,
So
internal.
can there be diversified, ma?
Yes, it can be diversified. All systematic risk cannot be diversified.
Okay. So systematic risk. Ma, you want to say something? Madam Victoria. Now we have two Victoria in this class.
No, sir.
Okay. So systematic risk. The asset beta measures only the business systematic risk. And this business risk is also known as what? Operating risk. And when we talk about this business risk, it is a risk that is associated with the company's operating cash flows, such as sales, variable costs, scrap value, initial outlay, and the rest of it. Let me take my slide to where I have this systematic risk. Yes. So we have two types of business risk. We have the unsystematic risk. These unsystematic risks, they are company-specific risk. They are company-specific risk. It is the risk that affects a specific company or industry. Please take note of that. Unsystematic. The risk that affects a specific company or industry. And one thing with this risk is that what? They can be reduced or eliminated. While the systematic risk is the market risk. This is risks that affect the entire market or economy, and they cannot be eliminated. And such risks include things like inflation, exchange rates. Once we have inflation, it's affecting everybody in the economy. You cannot eliminate it. You can only minimize, you can only mitigate it. Try to see how you reduce the effects on your business. So this systematic risk is due to general economic factors such as the level of inflation or changes in exchange rate. So let's take note of these differences. Let's take note of these differences. Now, talking about project-specific cost of capital, I will just talk about it. I will not solve question on it. Yes, because it's a special issue on its own that I will not want confusion. Yes, it's a special talk on its own. If I begin to talk about this, don't get scared. It's very simple. Yes, but I don't want confusion. To solve questions on project-specific cost of capital, there are various steps we must follow. There are various steps we have to follow. Now, number one step is to identify. We need to write so that the understanding will be much. What I have here is just the summary of the step, but I need to. So steps involve in calculating project-specific cost of capital. Project-specific costs of capital. The number one step, you need to identify in the question. The question will be paragraph of questions, stories. So you should be able to identify in that story where the proxy company is. You need to identify the beta. The beta. Identify the beta of the proxy company. Beta. Of a proxy company. Of a proxy. Of a proxy company in the new industry. In the new industry. And confirm. Take note of this. And confirm whether it is what? Whether it is geared. Confirm whether it is geared or ungeared. Whether it is geared or ungeared. What do we mean by geared or ungeared? A geared company is a company that has debt in its capital structure. An ungeared company is a company that does not have debt, only financed by what? Equity. So a geared beta is an equity beta. Is an equity beta that incorporates both what? Both business. Please follow this statement. They are very important. Incorporate both business and financial risk. Both business and financial risk. Whereas an ungeared beta measures only business risk. Measures only business risk. And ungeared beta is an asset beta. I'm just writing these stories to make the understanding much better. If not, I have my summary. I will just identify the proxy beta. But beyond identify the proxy beta, you must know what the proxy beta or proxy company entails. If the proxy company has elements of debt and equity, you need to identify that. So a geared beta, where you are given a geared beta is an equity beta that incorporates what? Both business and financial risk. Whereas an ungeared beta measures only business risk. An ungeared beta is an asset beta. So where you have this, where the beta given is geared, what are you going to do? Where the beta of the proxy company given is geared, what are you going to do? You ungear. That is the next step. You ungear. You ungear. See it here. Ungear. Ungear the beta. That is the equity beta. Take note of that. Ungear the equity beta. So, ungear. If the proxy beta is geared, in order to remove the financial risk, because what you are interested in is just the business risks. The business risks. You are none of your business with the capital structure of the proxy company, but you want to identify what business risks is the proxy company facing. So you do what? You ungear. So if the proxy beta is geared, in order to remove the financial risk, what do you do? Okay, ungear if the proxy beta is geared in order to remove the financial risk. So this can be calculated as follows. Can be calculated as follows. Let me see this. It can be calculated as follows. Copy this. That is using debt equity proportion. Using debt equity proportion of the proxy company. Using debt equity proportion of the company, of the proxy company. Or let me write this because I recall last diet there was something. Let me write this. It can also be in this form. Or I need me to change this. It can be equity beta geared divided by multiply by 1 divided by what? 1 plus 1 minus t. 1 minus t. That's all over what? Equity. Hope this is not becoming scary.
It is. Let's see. Oh.
That's why it's You write it, then you go and read it before we solve questions. So I want you to go and. But there's something we need to note still. Let's take notes. However, if asset beta if asset beta is given, what you're trying to determine here is this asset beta. If asset beta is given, step 2 above should be ignored. What do you do next? Hence, proceed to what? To step 3. Once you have asset beta given in the question, you don't need this step 2. So the next step will now be what? Once you ungear, the next thing is to do what? Is to regear. So regear the asset beta. Calculated in step 2. The asset beta calculated in step 2 above. That is, if the new project is financed with debt capital. Please, this is the summary of all what I'm saying, but for understanding purpose, that is why I'm writing all this. Yes, I can just do a voice notes. First step, identify the proxy beta, ungear, regear. You understand? Determine the CAPM, estimate the WACC. Very simple. Yes. But beyond this, when you are faced with question, what will you do? So that is why I'm writing these stories. But the summary of all what I'm saying is this. It's just as simple as this. Yes. But beyond this, there can be some silent issues that you need to identify. So regear the asset beta calculated in step 2 above if the new project is financed with debt capital. So this is necessary. In order to account for financial risk that reflects the method of financing the new project. That is using debt equity proportion. Of the investing company. So how do you do that? You can do that using this formula here. There are various formulas. I will show another one. You can do that using this, or you can do that using this, equity beta geared. We have asset beta. Asset beta. I'm just showing you two formulas for each of these so that asset beta into the bracket of what? 1 plus open bracket 1 minus t divided by or multiply by debt and equity. Debt equity. So all these can be in brackets. So this is you regearing. So you can either use this formula against this formula. You use this formula against this formula. So whichever, when we start solving, we'll see. So once you regear, what will be the next thing? Once you regear, the next thing will be what? Step 4. Once you regear, the next is for you to calculate what? Calculate cost of equity. Calculate cost of equity using CAPM. Using CAPM formula. You know, we said we can calculate cost of equity using business valuation model and CAPM. So this is where that knowledge will come. Using CAPM formula. And what is that CAPM formula? Using CAPM formula. This is the CAPM formula. Using CAPM formula. So this is it. So once you determine your cost of equity using CAPM formula, the next thing is to do what? Calculate project specific weighted average cost of capital. Project specific weighted average cost of capital. Weighted average cost of capital. Which is what? Which is WACC. Which is WACC. And how do you do that? You know the formula, right? For WACC. We just talked about it. It can be in this form. Yes. Formula for WACC. So all these steps is when a business is trying to diversify into another business or into another sector that is different from its existing business. That is when we consider this. That is when we use this step. That is when we use this step. So now, I said I'm not going to solve a question tonight, but let's look at, I'll forward a question. This question, you study it, then we treat it briefly in our next class. Treat it on our next class. Then we'll spend much time on this. Though I like the way we spend time on cost of capital because it's very important. So we'll treat this question in our next class. But I want you to go and read it and draw up certain information from it, so that when we come, we'll be able to solve as appropriate. So this is a question on project-specific cost of capital that I want you to read ahead and we'll solve in the next class. So before the next class, the chapter 1 of financial management, based on the syllabus, I'm going to see what we can do about it. I would divide that aspect into various topics, and I'll divide the class into different groups. Then we'll come and talk about it. I'll see the topic, I'll divide it. Then after that, we'll now move into investment appraisal. So I'm supposed to move to investment appraisal immediately after this, but I don't want to do that so that I'll not get you bored with much calculation. So we'll discuss financial management, the theoretical aspects. After we conclude this project-specific cost of capital, then we'll move to a theoretical topic. Then we'll go back to investment appraisal, which is also a very important topic that you cannot run away from. So, any question? I'll forward this slide to us as soon as we conclude. For any question before we call it a day?